Hello, everyone. Welcome back. Today we are looking at Chapter 4. In Chapter 3, we explored the accounting information system, how businesses capture and organize financial data. Now, Chapter 4 builds directly on that foundation, and it is absolutely essential if you want to understand how financial statements are actually prepared, and more importantly, what they truly tell us about a business's economics. This chapter is a big one because it shifts us from simply recording transactions to truly reflecting the economics of what's happening in a company. The key here is the accrual basis of accounting, which is the standard under generally accepted accounting principles, or GAAP, in the US. It's fundamentally different from cash basis accounting, which only recognizes revenue and expenses when cash actually moves. That might work for a very small hobby business, but for companies that need accurate and transparent reporting, cash basis just doesn't cut it. Accrual accounting records transactions when they happen, that is, when services are performed or obligations arise, not just when the money hits the bank. That's the crucial shift in thinking. Let's look at a few core principles that guide this accrual approach. First is the periodicity assumption. This is the idea that we can divide the life of a business into discrete chunks of time, such as months, quarters, or years. This allows us to measure and report performance regularly. Most businesses use a fiscal year, which might or might not align with the calendar year, but the important thing is that we're segmenting time. Next is the revenue recognition principle. This principle states that revenue should be recorded when a performance obligation is satisfied. In simpler terms, this means when the company actually does what it promised to do. For example, if a cleaning service is performed on June 30th, but the customer doesn't pay until July 5th, we still recognize that revenue in June. Why? Because that's when the service happened, when the work was done. Closely tied to that is the expense recognition principle, which is very often called the matching principle. This one tells us to recognize expenses in the same period as the revenues they help generate. So if we use up supplies or pay wages to deliver a service in June, those expenses are recognized in June, even if the bill isn't paid until July. The goal is to match the costs of earning revenue with the revenue itself. Now, because we're not just recording cash and we're following these principles of periodicity, revenue recognition, and expense recognition, we need something called adjusting entries. These are absolutely critical. They make sure our trial balance, which remember is just a list of all our account balances, truly reflects all activity that should be recorded in the period. Adjusting entries are always made at the end of each accounting period, and it's important to note that they always affect one income statement account and one balance sheet account. This is how they bridge the gap between cash transactions and the true economic picture of the business. We break adjusting entries into two broad types: deferrals and accruals. Let's start with deferrals. The first type we'll look at are prepaid expenses. This is when we pay cash for something upfront, like office supplies, insurance, or even rent. And we initially record it as an asset because we haven't used it yet. But as we use up that asset over time, for example, as we use the supplies or as the insurance coverage period passes, we need to shift that cost from an asset to an expense. Before we make this adjustment, our assets would be too high and our expenses would be too low for the period. Depreciation is actually a special type of prepaid expense adjustment. It's how we systematically spread the cost of long-term assets like buildings, equipment, or vehicles over their useful life. Instead of expensing the entire cost when we buy them, we allocate a portion of that cost to expense in each period the asset helps us generate revenue. The other major type of deferral is unearned revenues. This happens when we receive cash from a customer before we actually do the work or provide the service. Think of it like someone buying a gift card or a client prepaying for a year of services. When we get that cash, it's not yet revenue, it's a liability because we owe them something. As we provide this service or deliver the product, we then recognize the revenue and reduce that liability. Then we have accruals, which are essentially the opposite of deferrals. These are transactions where the economic event has occurred, but cash hasn't changed hands yet. First up are accrued revenues. These are revenues for services we've already provided or goods we've delivered, but we haven't yet billed the customer or collected the cash. For instance, imagine a consulting firm completes a project for a client in October, but they don't send out the invoice until November. Under accrual accounting, we still need to record that revenue in October because that's when the work was done and the performance obligation was satisfied. Next, we have accrued expenses. These are costs we've incurred, meaning we've used up the benefit or the obligation has arisen, but we haven't yet paid them. A classic example is wages earned by employees at the end of the month that won't be paid until the next payroll cycle. Even though the cash isn't dispersed until the following month, the expense was incurred in the current period. So we must record the expense now and also recognize a liability for the amount owed. These adjustments are crucial because they ensure our financial statements accurately reflect what we truly earned and what it cost us to earn it during the period, not just what cash came in or went out. Once we've made all of our adjusting entries, the next step is to prepare an adjusted trial balance. Think of this as an updated list of all our account balances, but now they're complete and accurate for the period, reflecting all revenues earned and expenses incurred, regardless of cash movement. This adjusted trial balance is the essential starting point for creating our main financial statements. From this adjusted trial balance, we can then prepare the income statement, which shows our revenues and expenses and calculates net income for the period. We also prepared the retained earnings statement, which bridges the gap between the income statement and the balance sheet by showing how net income and dividends affect the company's retained earnings. And finally, the balance sheet, which presents a snapshot of the company's assets, liabilities, and equity at a specific point in time. The last step in the accounting cycle for a period is to close the books. This is a very important process where we reset all temporary accounts, specifically revenues, expenses, and dividends, back to zero. We do this so that we can start fresh for the next accounting period and measure performance accurately without carrying over balances from previous periods. At the same time, the balances from these temporary accounts are transferred and updated in the retained earnings account, making it a permanent account that accumulates the company's earnings over time. Understanding how all of this works, from adjusting entries to closing the books, is foundational. You'll use these concepts again and again as we move through more complex topics. So as you dive into Chapter 4, take your time. Pause to practice the examples. Use the knowledge checks. And of course, reach out with questions if anything feels unclear. You don't have to master it all at once, but every bit you understand now will pay off in the next chapter, especially when we start looking at merchandising operations and multiple step income statements. You're doing great. Keep going, and remember, you've got this.